If you're a business owner, you need to watch this case all the way through, because this owner didn't get into trouble from aggressive tax strategies. He was doing things you might be doing right now: taking cash, keeping incomplete records, using verbal agreements, writing off close enough expenses, changing explanations over time. At first, this looked like a routine audit, but then something changed. The IRS stopped asking, "Do the numbers work?" and started asking, "Can we trust anything here?"
So this didn't start as fraud?
No, it started as a weak return, and that's how big problems begin. In this case, the owner, let's call him David, was running everything through an S corporation. The company, Summit Bridge Services. The business activities were normal: tax preparation and shipping logistics work. Sounds reasonable, right? This wasn't a side hustle. This was a real business. Real income, real clients, real expenses, file tax returns every year. But here's the problem. A lot of business owners think if the business is real, if the income is real, if the expenses are real, then I should be fine. But in tax, reality does not equal defensibility.
So if the records are messy, the whole return becomes questionable?
Exactly. The more real and complex your business is, the more proof the IRS expects, because complexity gives the IRS more places to dig. Now, here's one of the most dangerous facts in this case. The business received a lot of payments in cash. It also paid many expenses in cash. And even more importantly, not all income was deposited into the bank accounts, which means the bank records did not reflect the full business activity. If that sounds even a little familiar, you need to pay attention here, because this is an area the IRS looks at very closely. Once income and expenses stop flowing through a clean, traceable system, the IRS stops asking, "Do the numbers work?" and starts asking, "Can we rely on these records?" Or worse, "Can we trust anything here?"
So now it's not about the money anymore, it's about credibility.
Exactly. And once it becomes a credibility issue, it's much harder to fix than a math problem, because numbers can be corrected, but trust is much harder to rebuild. Now, this is where many business owners get trapped. The company claimed a long list of deductions: bad debts, rent, freight, and purchases, travel, entertainment, contractor payments, commissions. All of these sound normal, right? And that's exactly the problem. The more normal something sounds, the less people question it. Most business owners think, "This is a standard expense. Everyone claims this, so it should be fine." But here's the reality: a normal deduction does not mean it will be accepted.
Right, just because it says rent doesn't mean the IRS agrees it's actually rent.
Exactly. The label on the return is not the evidence. The IRS doesn't care what you call it. They care whether you can prove it. It got worse. David was using numbers that didn't come from his own records. A relative maintained spreadsheets. Another person provided totals for part of the business. He didn't request the receipts, the invoices, or the supporting details behind those numbers. So the return was built on amounts he could repeat, but not defend. And this is where a lot of business owners need to pause, because it's very common to say, "My bookkeeper handled that. Someone else gave me that number." But in an audit, that doesn't protect you.
That's a real trap. People think if someone else has it, that's enough.
It's not. You can outsource bookkeeping. You cannot outsource audit responsibility. The owner also claimed unreimbursed employee expenses from a separate W-2 job. Vehicle expenses, cell phone expenses. Sounds reasonable, right? A lot of people still think this is allowed. But here's the problem. The employer's policies did not support his story. The company discouraged using personal vehicles for work, and supervisors did not confirm his version of events. So now the issue becomes not just documentation, but whether the facts are even true. And more importantly, under current federal tax law, most unreimbursed employee expenses are not deductible.
So the issue isn't just missing records, it's that it shouldn't have been deducted at all?
Exactly. When your story doesn't match reality, the IRS sees it immediately. And once the facts fail, the deduction fails. Now, here's a trap that many business owners don't even realize: bad debt deductions. A lot of people think, if a client didn't pay me, I can just write it off as bad debt. Sounds logical, right? But here's the issue: this S corporation was using the cash method, which means if the income was never recognized in the first place, you generally cannot deduct it as a bad debt.
Wait, so if you never counted the income, you also can't deduct it as a loss?
Exactly. This is not a record problem. This is a tax logic problem. Even with perfect documentation, this deduction would still fail. Some deductions fail twice: once on the facts and once on the law. Next comes a situation that a lot of business owners face. The company claimed a rent deduction, but the rent was paid to a family member. The business was operating out of a basement in a home owned by family. Sounds reasonable, right? And they had a verbal agreement. But here's the problem: no formal lease, no clear payment records, no strong documentation. So what happened? The IRS allowed a small portion and denied the rest.
So we had an understanding doesn't count in tax?
Exactly. In tax, we understand each other is not evidence, and the closer the relationship, the stronger the proof the IRS expects. Now we get to the area where most deductions fail: travel, entertainment, commissions, contractor payments. These are expenses almost every business claims. But here's the issue: in this case, there were no reliable records, no clean reconstruction, no clear explanation: who was paid, how much, and why. None of it was clearly supported.
So can you at least estimate if it's close?
No. For certain types of expenses, the tax court does not allow estimation. Without strict documentation, the deduction fails completely. It's not close enough. It's zero. Now we reach the turning point of the case. The IRS requested records, but here's what happened: very little was provided. The owner claimed more records existed, but didn't produce them. Then he said a flood destroyed the records. Sounds reasonable, right? But no photos, no insurance claims, no strong evidence. And more importantly, he made no real effort to reconstruct the records from other sources.
So the issue isn't just losing records, it's not rebuilding them?
Exactly. Many cases are not lost because nothing existed. They're lost because the taxpayer failed to reconstruct and respond properly. The IRS doesn't just evaluate your records, they evaluate how you respond when things go wrong. Now we get to one of the most damaging issues. The explanations kept changing. One version during the audit, another version later. The court specifically noted implausible statements, unsupported claims, and inconsistent explanations. And once that happens, the issue is no longer, is this deduction valid? It becomes, can we trust anything this person says?
So now the IRS isn't reviewing expenses, they're judging credibility?
Exactly. And once credibility drops, every deduction gets more scrutiny and it becomes much harder to recover. Now, this case became even more serious because the owner was not inexperienced. He had formal education in business and accounting and years of experience preparing tax returns. In other words, he knew what he was doing. And that matters a lot because the court no longer sees this as he didn't know. Instead, they see it as he should have known.
So the more experience you have, the higher the risk?
Exactly. In tax, the more you know, the weaker "I didn't know" becomes. Experience does not protect unsupported deductions. Now the case escalates to its most serious stage. The IRS asserted civil fraud penalties. What does that mean? The IRS is saying this is not just a simple mistake. It reflects a pattern of behavior. So what does the court look at? Classic indicators: overstated deductions, poor record keeping, cash-heavy activity, failure to cooperate, implausible explanations, low credibility. And here's the key: it's not just one issue, it's the pattern of all of them combined.
So this isn't just you lose the deduction, it's everything is questioned?
Exactly. Once it becomes a pattern, the IRS stops reviewing individual items and starts evaluating the entire behavior. Fraud penalties require strong evidence, but once applied, the consequences are severe. So, what should you actually take from this case? It's not never claim deductions. That's not the lesson. The real lesson is don't build your business on weak proof. Don't rely on cash without a clean trail. Don't use numbers you cannot support. Don't depend on informal agreements. And don't assume close enough is acceptable. Because the real value of cases like this is simple. You get to see the mistake before you make it.
And not after the IRS points it out?
Exactly, because once you're in an audit, your leverage is already reduced. So, what was the final outcome? The IRS prevailed in court. Most of the deductions were disallowed, and even more importantly, fraud penalties were upheld for multiple years. And here's the key takeaway. Many business owners believe the worst case scenario is the deduction gets denied. But in reality, the real risk begins when the IRS decides this is not just an isolated issue, but a pattern.
So it's not about one expense. It's about the overall pattern?
Exactly. The IRS doesn't just review line items, they evaluate how everything fits together. Now, here's the question you should ask yourself. How many small weaknesses exist in your records right now? Cash without clean tracking, expenses without proof, numbers you can't explain, verbal agreements, inconsistent explanations. These issues don't always cause problems immediately, but once the IRS looks at them together, they become a pattern. And once you're in an audit, fixing these issues becomes much harder because it's no longer just about records, it's about credibility. But here's the good news. If you can see the problem early, you can fix it. That's your advantage. Follow Ivy Smart Tax. The Tax Trap series helps you spot risks early, understand tax logic, and avoid the most expensive mistakes.
The real win isn't fixing it later, it's never stepping into the trap in the first place.